We just got a new report which said that our job market is cooling. But the reason why this is so important isn't because of where unemployment rates are today, but because, well, just a few days ago, Fitch, who's one of the three major credit global rating agencies, came out and downgraded the United States of America as an investment from a AAA rating down to a AA+ rating. The last time this happened was back in 2011, and the reason why this is significant is because Fitch is saying that when you lend money to the United States, it's more risky than what was previously thought because of the growing national debt, because of growing concerns of the economy in the United States. Now, when that happened, people and investors and governments who lend money to the United States said, oh, the United States isn't as safe of an investment as we thought. We need a higher return. So this caused then treasury yields to rise, aka the interest rate that a United States government has to pay out on loans to go up. And the reason why this is significant is because this is going to play a factor into the jobs market. Now, there's been people talking about the latest jobs report. There's been people talking about the latest credit downgrade. But what I want to do is talk about how these two things interact with one another, because there hasn't been a lot of people that talk about that. So if we start by talking about the jobs report, what the jobs report said is that last month our economy added 187,000 jobs, which is less than the 200,000 jobs than was expected. This isn't that big of a deal. Our unemployment levels are still at 3.5%, which historically is some of the lowest unemployment that we have ever seen in the history of the United States. But there are two things that you need to remember about the current state of the job market. Number one is that the Federal Reserve Bank, who is our central bank here in the United States, is expecting, this is public on their website, and they've said this multiple times in press statements, that they expect unemployment to rise to 4.5% to keep inflation down. Now, what does that mean? Well, unemployment's at 3.5%. If unemployment were to jump up to 4.5%, that would mean mathematically that about 2 million Americans would have to lose their jobs. The second thing you have to understand is how the higher treasury yields are going to impact businesses, because the higher treasury yields have a broader impact, not just on what investors get and expect when they lend money to the government, but it has an impact on the broader economy. So let's start by jumping into, well, what do treasury yields do? But before we do, I want to give you a quick reminder that on August 15th, 2023, it is the 52nd anniversary of the United States dollar being taken off of the gold standard. And on that day, August 15th, I'm hosting my first ever investor summit. It is completely free. I'm going to be going over three things. Number one, how our economy has changed. Number two, how our money has changed over time. And number three, how you can find and capitalize on investment opportunities today. There's going to be a ton of value in this investor summit. It's completely free. So if you'd like to join me on my first ever investor summit, I got the link to how you can join me down in the description below. And I'm making a video like this because we've been having some electrical issues in the office, and I'm about to leave for Manhattan to prepare for the investor summit. So I'll see you on the investor summit, and let's jump back into the video. Treasury yields are important to understand because a treasury historically has always been considered the risk-free return. What that means is if you lend money to the United States government, it has historically been considered a risk-free investment, where if you give money to the government, they will pay you back plus interest, whatever they pay you. It is guaranteed. Every finance and economic book has always said this. But when Fitch came out and they downgraded the United States, they pretty much undermined what every economics professor, what every finance book has ever said. Because what Fitch said is that the United States is a more risky investment than previously thought. Fitch is one of the three major credit rating agencies. When they downgraded the United States from AAA, which essentially means risk-free, to AA+, that adds an element of risk. Still extremely low risk, but there's an element of risk. Now, as an investor, when you invest your money, you generally follow the risk and reward model. The higher the risk you take, the better the return has to be. If it's a low-risk investment, you generally expect less returns. And so if you're lending money to the United States government, and this can be investors, people like you, people like me, this could be businesses, this could be hedge funds, this could be other governments, this could be the Federal Reserve Bank. When you lend money to the United States government, you're going to expect a return. And if the risk is higher, you can expect a higher return. So when Fitch came out with this downgrade, what we saw happen was that treasury yields spiked. They have come down since, but they did go up. Now, what does that mean? That means the risk-free rate has gone up. And the reason why that's important isn't just for now the return that you get when you lend money to the government. It's because of how it impacts the broader economy. Because now banks look at the risk-free rate, and they say, okay, if we're going to go out and lend money to you, right, for a mortgage, for a car, for a credit card, for a business, whatever it might be, we have to compare what our options are. And we have to compare what the different risk levels are. And if we can lend money to the government and get a better return, we would rather do that than take a risk with you, because lending money to you to go out and get a mortgage is more risky than lending money to the government. So this is where now banks are looking at the risk-free rate and saying, if risk-free rates are rising, our mortgage rates have to also rise to make up for the higher risk. Because again, risk-free rate is now the baseline. And so if the government treasury yields are rising, well, that's going to impact the debt costs of mortgages, credit cards, everything else. And that hurts businesses too, because now businesses have debts and they also want to raise more debts. They raise debt to go out and finance new machinery, research and development, and they already have existing debts which are going to come due. We're seeing a huge level. I think it's about $1 trillion worth of commercial real estate debt that's going to be coming due by the end of 2024. And the reason why that's significant is because if a business now is seeing their debt servicing costs rising, because a lot of corporate debt is not 30-year fixed rate mortgages, it's readjustable rate mortgages. If in the coming 12 to 24 months, we see a big chunk of debt readjust and payments go up because businesses were able to borrow money at the lowest rates ever back in 2020 and 2021. So now in 2024 and 2025 and 2026, when interest rates readjust, if payments are significantly higher, that means businesses, landlords are going to need more income in order to keep making these payments. And where do they get that income? From people, from the businesses. And if revenues are falling or they're stationary while costs are rising, that's going to put a lot of businesses into a bind. And this is where now understanding this credit downgrade is so important, because the last time we saw this downgrade in 2011, it happened after the 2008 crash and it happened after the debt ceiling dilemma. Well, this year we had the debt ceiling dilemma, we had the pandemic, but we're still facing inflation issues and we're still facing interest rate issues. Like, we have gone from the lowest interest rates ever in 2021 to now the highest interest rates today in more than 20 years. And this change from the lowest interest rates to the highest interest rates in 20 years happened in a span of 18 months. There's going to be a cost to this. And what I've read, this is not me saying this is from like the New York Times and a few other places, what economists are essentially saying is that right now we only have one credit rating agency that has done this downgrade. If we were to see a second credit rating agency do this downgrade, that would have a major impact on treasury yields. Because naturally, if investors are worried about lending money to the government, that is going to make investors demand higher interest rates for their money. And that is the concern. Because if treasury yields rise, the concern isn't now the interest rate that you're going to get. The concern is, how is that going to impact mortgage rates? How is that going to impact credit card debt? How is that going to impact business debt at a time where we're already facing the largest debt burden in the history? And the second impact of that is, what about all the businesses and landlords that have billions, if not trillions of dollars collectively coming due in 2024, 2025, and 2026? We're supposed to start seeing some of this readjustment happen towards the end of 2024. The bigger chunk will be starting in 2025, and then into 2026 is when we're going to really start to see the culmination of all the debt. And so if interest rates stay high and you start to see those debts readjust, that's going to have impacts on the economy. So the question is, what does that mean? And this is where time will tell. And you've heard me say this time and time again. That's why 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart, because these things are happening, and that's going to have an impact on the jobs market. Remember, the Federal Reserve Bank is expecting unemployment levels to rise to 4.5%. They say that the labor market is too tight, which means that we have too many jobs out there. And they're trying to correct that as a way to cool down inflation, because when everybody has a job, that means that people can quit jobs and go out and get another job and keep renegotiating their salaries higher. That might sound like a good thing, and it is if you are an employee. But from the Federal Reserve Bank's eyes, what that means is, that means it pushes wages higher quicker than what they want. And if wages are going higher quicker than what they want, that means people have more spending ability. Because if you can go from, let's say, 40,000 to 45,000 to 50,000 to 55,000, it's good for you. because now you're making more money. But if you're making more money, that also means you have more spending ability. Not just because you're making more money, because when you also make a bigger salary, that also means you qualify for more debt. You can get bigger credit cards, you can get more mortgages, you can get a bigger car. So when you can qualify for more debt, you also have more spending ability. So now what does that do? Well, inflation is a byproduct of spending, right? When there's more money in the economy, you have more ability to spend. And so if you can spend more, well, that increases demand. And if demand is up because people have the ability to buy, that continues to keep inflation high. This is one of the reasons why the Federal Reserve Bank wants to see a cool down in spending. They want to see also a cool down in the labor market. And now they don't come out and say we want more unemployment. That's a politically incorrect way for them to say it. So what do they say? They say the labor market is too tight, and we want to see a softening in the labor market. That means we want to see more unemployment. So this is where understanding that we have a lot of impacts coming in the economy, and the thing that you want to pay attention to isn't just interest rates now, but really the bond market. Because if we continue to see growth in treasury yields, and maybe I should do some more videos on bonds and how treasury bonds work and how that impacts the economy. Got me thinking on this. But this is something that you want to be paying attention to. We keep you updated in the market briefs. I'll be talking about this in the Investor Summit. But this is something that you want to be paying attention to now, because if there are more concerns about lending money to the government, that is going to push up treasury yields. If you continue to see a higher treasury yield, that could then impact interest rates, which should have an impact on the economy. And this is at a time where the Fed could potentially keep raising interest rates. So these are two factors that kind of play each other out when it comes to raising interest rates. The Federal Reserve Bank and treasury yields, both of these two things affect the interest rate that you pay. And if interest rates keep rising, that's going to have a broader impact on the economy. And that's what we'll be keeping you posted on over here.